We saw that pretty much yesterday. While yes, we did lift off from the session lows, we did see a recovery coming in, largely thanks to the kind of earnings plays which panned out. What with the move coming in on a Bajaj Auto, on an LTIM, a Hero Motorcorp, or for that matter, Nestle. But having said that, our low bias continues. Even yesterday, time and again, we tested that 19,600 print and closed in just a shade around that mark itself. This morning, of course, lots has changed. You've got a very, very hawkish commentary coming in from Jerome Powell. And that's really, not had a great impact on the 10-year yield, which has escalated all the way to 5% once again. And that's really bringing about some amount of fear on the street out there. So you are seeing a very, very weak handover from the global markets once again, pegging us to start off once again around that 19,500 mark.
Yes, indeed. And it's interesting just to take off from what you were talking about, the US Fed, Jerome Powell, and he reiterated the central bank's commitment to moving forward very carefully with further rate moves, saying that the central bank might just need to raise interest rates going forward if the economic data does remain hot. And he did say that bond yields as well, rising bond yields could mean less need to hike rates down the line. And you can see the play out impact as well on Wall Street as well as on Asia this morning. But that aside, then let's put the spotlight on the major earnings as well. And yesterday it was all about FMCG. You had big earnings that came out from that space, HUL, ITC as well as Nestle. And let's just stack it up. It was a slight beat when it came to Nestle. You had better realizations that really aided the margins. The volume growth, that was a bit of a miss this time around when it comes to Nestle. For HUL as well, a 2% volume growth was clocked in, but that was a little bit below what the street was penciling in. The competition in the mass products from smaller players was evidenced. It was an inline set of numbers. That's how you can categorize it. And what the commentary we were watching out for with respect to rural recovery, the management acknowledged that it is going on, but it's at a very gradual pace. And despite the fact that there was higher A&P costs, they did manage to see a margin expansion. So that was HUL for you. And then you had heavyweight ITC as well, and you could categorize the numbers as in line with street expectation. The 6% volume growth did manage to beat street expectations. The hotel business as well was aided largely on account of travel, G20, agri value-added products drove growth, and Aisha, green shoots for rural recovery, which I think is what the street wanted to hear.
Oh yeah, absolutely. The fact that they are saying that they do see some signs of rural recovery, that is, I think, what the street is going to take heart from. Of course, it remains to be seen what the rural focus plays like Marico, like Dabur actually deliver once their quarterly numbers are out. But that 6% cigarette volume growth managing to beat street estimates, where the street was a little concerned that the volume growth for the cigarette segment is going to come in between the range of 4 to 5%. I think that's going to really hearten the street. And ITC has been a smoking hot performance from all counters. So that definitely is one stock to look out for today. In fact, let's hear out what Unilever's management had to say about, the demand environment and what's their take now on the signs of a rural recovery.
What we're seeing for rural, the demand is recovering gradually. And of course, the point still is that the growth that we're seeing now of roughly 7% volume in rural market, it's on a base of a 9% decline same period last year. So if I look at a 2-year basis, there is still a marginal 1% decline in rural volume, which means the markets are not yet fully recovered. So that's one. But what is really helping this point in time, the recovery, the point Rohit mentioned earlier, inflation moderating gives more disposable income to rural consumers. That hence is leading to recovery of demand, though gradually. We have seen the real rural wages, which were negative, have now come into some positive territory. That's a good news. We have seen that the government expenditure to support rural economy had been increased a few years back, and that has been maintained at a high level. That is helping rural recovery. And equally higher amount of capex, which is getting spent both in last budget and the current budget put together, that is also supporting overall rural income. So there are many factors which are, let me say, in favor of rural demand recovery, albeit the recovery is gradual. And of course, to Rohit's point earlier, we have to watch out in terms of monsoon. Monsoon has been uneven, and we know that we're ending the period with a lower amount of reserve level as well. So we have to see what impact it plays out on the Kharif output now and Rabi sowing later point in time. Overall, we do remain cautiously optimistic and expect demand to continue to recover gradually. So that's on rural demand. And if I just probably answer your question on competitiveness, I mentioned in my opening remarks as well that overall we have seen small players when commodities do come down, and we have
Cautiously optimistic, that's the take coming in from HUL. But let's shift gears then and put the spotlight on Zomato, and that's in the news as we understand that Japanese tech giant SoftBank, this is via its affiliate SVF Growth Singapore, is likely to sell a 1.1 stake in Zomato, and this could happen via block deals today. Now, according to reports, the offer price that has been set is around 109.4 to 111.6 per share, and the transaction is valued at about 1,024 crore rupees. Do remember, SoftBank holds a 2.17% stake in the company as on the September quarter. In August as well, you had SoftBank, which had offloaded about 1.17% stake in a block deal, and that was valued at about 947 crore rupees, where a lot of prominent investors, the likes of Nomura, Invesco, Goldman Sachs, Morgan Stanley, etc., all did participate. And just to put into perspective, those are some of the other new age tech companies in which SoftBank does have a stake. Paytm, quite a sizable stake, as well as Delivery in double digits at about 14.5%. Zomato, as we just highlighted, and even a PB FinTech, a 4.4% stake. So that's interesting. Aisha will be keeping the spotlight on Zomato with respect to those block deals.
Yeah, Zomato in any case is going to be in focus considering Blinkit's losses are up over 8% and they're looking to hit almost, over 1,000 odd crore rupees. Well, there's nothing new in that comes as part of their quarterly updates. But yeah, that's going to be one stock definitely in focus. That said, let's throw light back at what the global commentary is like, especially in light of Jerome Powell's commentary and a very hawkish stance at that, and the spike up all the way to that 5% mark on the yield. For the first time since 2007, the yield has hit that mark. Let me take it across to Harsh and get a sense of what the global commentary is like. Harsh?
Well, yes. Let me start off with Ostan Goolsbee, who is one of the Fed presidents. He's suggesting that they don't expect to see a recession, and hopefully they can avoid it. Also, with regard to labor market, he's saying it's easing, but it's still quite strong over there. Housing shelter component of inflation is going to be a key measure that he's going to be looking at. Of course, auto strike risk on the economy hinges largely on the length of the strike as well as the size, how many people will be involved. Lastly, Fed's bar also suggesting that the bank stress tests need to be strengthened further. Then we had Peter Schiff, who spoke about US bonds being or rather treasuries being one of the riskiest assets at the moment, and therefore what he suggests is investors are going to start looking at a risk-off trade, and that will be gold, is what he seems to be suggesting, and therefore he believes that gold will be the next asset class which will be in focus. Ray Dalio, I'll quickly move on. He's suggesting that hot wars are going to be a reason for serious concern. In fact, he points out at both conflicts, Russia, Ukraine, as well as the one happening in the Middle East at the moment, and he suggests that such wars haven't happened in a very long time, especially between major powers. He suggests that there could be chances of a China-US conflict, and the chances of that has really gone up in recent years, and he warns of that, including the rise in military budgets. Lastly, Federal Reserve's Harker also suggests that the Fed should hold the interest rates steady through this even though economic growth is coming through in a steady fashion. He believes that the Federal Reserve is at a point where they are able to hold rates, largely also because the 10-year bond yield has been going up. So far, the economic and financial conditions are evolving, he says, and roughly as he has expected, it has been evolving, but he's keeping a close eye on the latest data, which is coming in a tad stronger than his baseline forecast. So that is, of course, Harker of the Federal Reserve and his comments.
Lots of commentary to, dissect as well as understand. Let's bring on board Arvind Sanger then to do exactly that. Arvind, hi, morning. We just heard from what the Jerome Powell commentary was to how the globe has reacted to that. Hawkish to say the least. But, the one thing that he said was, and, alluding to the higher bond markets, And he said that a higher bond, in a way, is tightening. And he said, and therefore, the margin, or rather, at margin, could actually reduce the need for Fed to tighten further. So one was assuming that it's going to be higher for longer, the interest rates. He said that Fed wouldn't have to act because the bond yield in any case is taking care of that. How are you digesting all the commentary?
Well, I think that at the end of the day, the most important thing for the market is the 10-year bond yield. So whether it gets higher because the Fed is tightening or it gets higher because the market is tightening, unfortunately for equity investors, the end result is the same. A, it increases the risk of a recession. B, it increases the discount rate, which should over time reduce the PE that the investors are prepared to pay for equities. So yes, maybe the Fed doesn't have to do it and the market is doing the job for it. But no matter how we end up with, if we end up with higher bond yields for longer, and I think he did imply that bond yields might have to stay higher for longer to make sure inflation and to make sure inflation goes below 2%. So he's still remaining very hawkish on the inflation target, which means he's willing to take a much more severe economic slowdown if that's what it takes. So, bottom line is, I think, be careful what you wish for. It wasn't, it was dovish from the sense that there is no more rate increase, at least in the November meeting result. But they're going to be watching and staying on the hawkish side if they need to raise rates, if the market starts to soften, if the rates start to soften. So I think the end result is unfortunately more hawkish overall.
Absolutely, and I think equity markets are feeling the heat from that as well, and pretty much across the global screen. But then what happens in this scenario, Arvind? I mean, do you see a risk off from equities and for a longer sustained period?
Well, I think the risk off from equities has a couple of headwinds, right? We have this whole oil Middle East. We don't know, you've got news now about these couple of, in Iraq and Syria, some drones going towards US bases, and you've got some Houthi rebels sending some missiles towards Israel. So the risk of that Middle East conflict spreading is high. The risk to oil prices is high. The risk of recession, inflation is high. So with all of these risks out there, I'm not sure why equity investors should be jumping up and down to put a lot more capital to work rather than being patient and seeing how some of these risks play out. So I think patience is the name of the game. I don't see any reason equity markets are going to run away unless, all of these problems go away magically tomorrow, which unfortunately doesn't look like it.
No, it certainly does not, especially with the niggling worries that we have about the Middle East as well playing out at a time like this. So, Arvind, what about India? Where do we stand in all of this? Do you think that if there is any risk that's likely to emanate, that will largely be globally driven, or we have problems of our own?
Well, India's actually inflation numbers that just came out in the last few days were surprisingly benign. So, one of our concerns has been that with the deficient, rainfall, monsoons being somewhat disappointing, there could be more hardening of inflation. But the latest data is clearly heartening. So that's the good news. The current account deficit is doing well. That is the good news. Oil prices are going up, and that's risky. And interest rates are going up in the West, and that causes some outflows. So net, India is better off than most other markets, but India is not immune to global recession fears and Middle East tensions creating any spike in oil prices. So India has some good news recently, and India's earnings this quarter should be pretty solid. But India is not immune to some of the risks of outflows, as well as oil prices and other spillovers from Middle East tensions.
We have been seeing those outflows for a while now. It's the DIIs which have been supporting the India markets any which way. But Arvind, great to have you on the show, and great to get in that perspective from you.
Thank you.
Okay, that's the word coming in from Arvind Sanger, sounding a word of caution on account of the elevated yields yields because of Jerome Powell's commentary, talking about how it could lead to further risk-off in equity sentiment. But let's find out exactly that. Are the charts reading the same or not? Kunal, Naresh here, as always. Kunal, hi, morning. We did recover from the damage of yesterday's lows, but didn't see the strength actually carry on. What are you making of the charts, and especially given the global weakness this morning?
Yeah, I think that's a bigger concern, the global weakness. That was not the case day before yesterday. Or, the handover from the global markets was not that negative. But I think with the 10-year spiking, I think that could probably add to more concerns on the index. And, even if you look at the last 3 days, we've gone through a very gradual kind of cool off. So from 19,800 in the last 2 days consecutively, we've managed to breach 19,700, and yesterday we were almost at a point of closing below the 19,600 mark. Today we could be opening at 19,500 levels for the index. So in the last 3 or 4 days, we've gone through a 100 point of gradual cool off for the indices. Next week is the expiry week. So what the trends for this week as well as for Monday, because it's a curtailed week, next week would have a significant impact into the rollovers also for the next series. So net, I think short-term traders could probably look out for more direction on the indices if you manage to break below critical supports. 19,300 approximately has been a major support, so we'll go for a short below those levels.
Naresh, hi, morning. Would banks take the inevitable hit? Are they likely to drag most?
So not really, but the drift lower continues. The case is whether we can break that 43,300, 500 mark, which has been the support for almost many months now. Yesterday also, after hitting those levels, very coming close to it, we saw recovery. The problem is in the banking index, none of the heavyweights actually are showing any sort of resilience or say support in a major way. So HDFC Bank, 20-25% of the weight, you still see it struggling around 1,500 mark. Then the next weight, ICICI Bank, which earlier was showing a lot of relative strength, was trying to hold on above the 960 mark, has drifted lower, but is yet away from a breakdown. So that takes away 40-50% of the index. Then you have the same case with Kotak Mahindra Bank, SBI. At the same time, you have an Axis trying to hold on, or IndusInd trying to hold on. But overall, the view is, as of now, we are still in this sideways zone wherein we may not break 43,300 odd levels very quickly, and not break 44,500 also quickly. Same is the case with the Nifty. We may not break 19,300 to 19,500 band quickly, but 19,800, 850 also looks difficult. So we are in the sideways flux for the market. No major trend as yet.
All right, there you have it, a sideways trend. That seems to be the consensus take from our charters. But what are they picking out at a time like this, Kunal?
So I'll go with one buy and one sell, focusing specifically on mid-cap names in this kind of a market. Atul Auto is something which I discussed yesterday as well. Recommended the stock closer to 635, 640 odd mark. Looks very attractive on the short-term charts, forming a classic bullish pennant formation on the daily time frame. So would suggest a buy with a target of 700. Stop loss could be kept at 600. And the second would be a sell on Birla Soft. That's a stock which I believe is likely showing signs of topping out formation on the daily time frame. So I would suggest a sell with a target of 528, stop loss 560.
Right, okay, those are a couple of stocks to look out for. Of course, the street is going to be reacting to ITC's performance. We'll have Unilever numbers as well to digest. So, sure is going to be a busy morning. But Kunal, since you do track the Dow charts as well, and the other day you were making an observation as to how that's looking like it's going to head for a breakdown. Breakdown it surely is turning out to be. Help us understand that along with the India VIX. What is the correlation between how the US equity markets are panning out and what it could mean for us?
Well, so generally there are 2 points which we look out for. One is, Dow Jones, whether it trades above or below the 200-day moving average. I think what we've seen is the Dow Jones actually, breaking past about 200 DMA and then falling lower. The second is what we look out for CBOE wicks, and typically we've seen sharp volatility rising up when the CBOE wicks crosses the levels of 20 to 24. Now, India VIX is a different ballgame altogether because we've not seen any jump in volatility. I think we've been just hovering into this range of 10 to 13, 13.5 broadly for the India VIX. So that's not showing the actual sign of volatility into the markets. But I think CBOE VIX is something to track, possibly above the 22 mark is where we expect a sharper correction.
That's the view coming in on the volatility index. But let's also find out what Naresh has on his radar. Naresh, what's looking good when it comes to individual stocks?
So two names. First is the buy on ACC. The stock has been sideways for the last 3 months, roughly around this 2000 mark. We've seen a breakout happen in Ultratech as well as in smaller cement names. So this is a triangle formation. The range has contracted. The stock had bounced back to these levels only in February 2023. So once it sustains that 2030, 2050 mark, could be a short-term breakout, take it towards 2200. So a good risk-reward trade here. Stop loss at 1970, target price of 2200. Second is a buy on Power Grid, a defensive stock here. The stock has been slowly and steadily trending up. So that's a stock which I like as such.
All right, there you have it. Those are all the top recommendations that our chartists are flagging off this morning. Let's move right on then and put the spotlight on individual stocks that will be in the news today and begin by discussing the fine print when it comes to earnings. Somit is here to discuss just that. Somit, let's talk about the earnings fine print from Voltas. It was a bit of a miss this time around. And what about Havells, given that there has been muted demand?
Well, both the consumer durable companies came out with numbers. So Voltas, if you see, their business was hurt again by the project business. Now, this is the fourth consecutive quarter where the project business has reported a loss, and yet again this has happened because of high provisioning that the company has done on the project business side. On the other hand, if you see the AC business, that reported a strong set of numbers as against what market was expecting. Around 20% volume growth is what the company has reported, despite weather concerns that we had. Now, market share wise, if you see, Voltas has yet again lost some market share, but they continue to remain the market leader, and given the fact that they are also expecting growth to be strong going forward. Now, when it comes to Havells, Q2 was weak because there was a shift in the festive season, but management commentary clearly indicates that they are seeing strong demand for the festive season. Along with this, on the number side, if you see, EBITDA was pretty much in line, but there was a big margin miss that had come in around 100 basis points, and that was largely on account of higher losses coming in for the Lloyd business that has yet to turn around for Havells in a big way. So Havells margins pretty much in line. Outlook remains strong for Voltas. It was losses or miss because of the project business, but AC business continues to perform well. And one point that the brokerage did make was that Lloyd's AC business has performed well yet again and has outperformed Voltas in the first half of financial year 2024.
Samit, last couple of years, frankly, have been lost years for capital goods stocks. Now, whether it is Havells or whether it is to some extent Bajaj, or even for that matter, you can throw in, Voltas. I mean, we can talk about this grandeur in terms of more electricity demand, more consumption in terms of, Indians are migrating their entire lifestyle. But frankly, none of the consumer stocks or consumer durable stocks really have kept up to the pace with which, let's say, some other categories have expanded. Voltas numbers have been hard to predict. I mean, it's very, very cyclical. But for Havells, I guess, looks like the darkest dusk before the dawn is actually getting over. I will not be surprised from here on if one really looks at Havells versus Voltas versus Bajaj Electricals. Havells has a much better path of visibility, and for Voltas the cyclicality in the business is so strong that it will get crunched. And Bajaj Electricals numbers have not come out, so we should not talk about it. But if you have to compare Voltas versus Havells, I think I would lean towards Havells, less towards Voltas. And what amazes me, Samit, is that for Voltas, the entire AMP business, which is what we call as the electrical engineering project business, it's a business which is growing for everybody. It's a business where other companies who are in the peers are actually growing and Voltas is suffering. So maybe they need to reorient themselves. I mean, it amazes me that most of the Tata Group companies have turned around, but here's Voltas, which is languishing at the bottom of the pyramid, so to speak, at a time when we are talking about private sector capex, engineering business doing well, their business from Middle East also has stabilized, but Voltas actually, Sabharwal likes it.
Surprising they haven't been able to cash in on the trend.
Yeah, so they need to reorient themselves. I mean, it comes from the house of Tata, so the Tata business is also so large for them that they can really fix it.
Yeah, absolutely. But Samit, tell us what's happening in the Alcobev segment, UBL numbers.
Well, yes, United Breweries numbers came in. Margins were a miss. Not a miss, in fact, it was a disappointment given the fact that gross margins declined by around 200 basis points. But this was pretty much on the expected lines given the fact that raw material prices, that is glass prices and barley prices, had increased in the second quarter of FY24. But what management is indicating that the inflationary pressures are now lowering. So this means that Q3 margins could see a rise going forward. And one other positive point that has come in from the United Breweries result was the volume growth. Overall volume growth was 7%, but the premium segment has seen a double-digit volume growth of around 10%. So that is a positive thing coming in. Now the company has a conference call today, so it will be interesting to see what commentary comes in from their side on volume growth going forward. And when it comes to United Spirits, it's its peers Pernod Ricard which has reported a growth of just 1% in its India business. Now this clearly means that United Spirits might have seen some market share gains in the second quarter of FY24. Now what brokerages are estimating is around 11% growth for United Spirits and market share gains, given the fact that Pernod Ricard did not grow as much as the street was expecting. So, but United Spirits is yet to come out with its numbers, so we'll have to see how that plays out.
Again, Samit, United Spirits, United Breweries, 3 years ago, what the market positioning is and versus where they stand right now, whether it is inflationary pressure or competitive environment. I mean, they are companies which have some of the biggest brands, both, I mean, they both are owned by different, global groups now. But both the companies, in a sense, if you frankly ask me, they've not really lived up to the kind of reputation they currently have. Now, whether it is the volatility in the barley prices or volatility in molasses prices or perhaps both, they've had margin problems. Volumes have not been extraordinarily strong. I mean, for United Breweries per se, you've got the entire landscape also really seems to be changing. Even though they have the most dominant brand, Kingfisher, I guess somewhere the superiority of Kingfisher also seems to be getting challenged now. So frankly, from a market standpoint, this has just been one of those stocks which could be called as a hope investment. That hope has not translated into reality. Because when you have a choice to choose, you would say that, do I choose an ITC which is giving me better margins, more consistency, and more promise of a dividend and hopefully a buyback soon? Or do I choose United Breweries, which is a pure play on Indian youth consuming more alcohol, and a company which has great brands? So the latter in this case has really not worked so far. So that's really been the sticky story, if you frankly ask me, for UBL. The management has changed. A lot was anticipated when the management changed. But frankly, in terms of not last quarter, but last couple of quarters, they've not really done something extraordinary. I mean, am I right if I say that?
Well, yes, in fact, Q1 volume growth was weak, but Q2 has come out, so we'll have to see on how the...
Yeah, I mean, it's not lived up to the reputation. Look at all the basic categories. I mean, you talk about restaurants, QSRs, cars. I mean, frankly, United Spirits and United Breweries have not really lived up to what was anticipated.
Yeah, betting on Radico Khaitan, right?
That's exactly the point.
Yeah.
I think, JM Breweries, Radico Khaitan, Radico, these stocks have done phenomenally well. And from 2020 lows, I think many of these stocks have actually given 2x or 3x or more than that kind of a returns. And United Spirits is where I think 30-40% kind of a return.
Yeah, they bought some of the biggest brands, even United Spirits and Breweries. And they are both owned by global, players now. It is Diageo and it is Heineken in one case. So they are global brands. They could have really changed the landscape per se. In the beer market per se, whatever my limited understanding is that you've got homegrown brands which are now challenging at least some of the traditional brands.
And I think that's the problem with the rest of the market as well, right? That there are the discovered names and then there are the gazillion other opportunities wherein you can have higher alpha generation. And I think that's exactly what's playing out within the alco-bev space as well. Samit, thanks for flagging off those stocks. We'll quickly take a break, come right back. We'll have our fundamental experts as well join in on the show.
Just now, and let's connect with him and let's say hello to him to understand that what his prognosis of the market is and where markets are headed. Vasim Saab, Nifty was supposed to cross 20,000. Ho hi nahi raha hai.
गुड मॉर्निंग निकुंज अगेन हो जाएगा, कोई चिंता नहीं है। इस अगले हफ्ते नहीं तो उसके अगले हफ्ते। अरे ब्रॉडर मार्केट देखो, एनबीसीसी न्यू हाई, बीएल कश्यप न्यू हाई, मर्सिडीज 10,000 crore sales, landmark cars rising its way. We are only caught in the bandwagon because of ETF selling and so on, which is a part and course that if there is going to be 5% yields, the whole world knows what is going on. But if I'm going to see Mercedes sales cross 10,000 crore, the wealth effect play out as far as construction, road building, etc., Ultratech's numbers, Lever's numbers, Bajaj Auto hitting 6% up on a result day, then I am missing something on the broader front. I can guarantee you, if not next week, by the first week of November, we are hitting 20,000 before Diwali, and that is a known. Secondly, Large part of all the negative news is slowly getting priced in. FIs are close to exhaustion. And I think that the retail flows, which has been the backbone of this market, that is what the market is. We are watching retail flows. FIs will come and go because they are fair weather friends and global circumstances. But please look at the broader market, Nikunj.
Can the broader market sustain independently? A question which we've debated and deliberated. Now, the naysayers were always of the view that broader market is unlikely to sustain because positioning was getting extreme, valuations were getting frothy, and the participation was growing in some of the mid and the small cap stocks which do not deserve to go higher. But so far the naysayers have got it wrong. Do you think small and mid cap stocks which have rallied, they would continue to rally on?
Yeah, that's a glass half full, half empty, Nikunj. I still think there is enough value because for years they have underperformed. And secondly, the access to capital for small and mid caps has become even more, the best ever. Thirdly, the environment is around you. You can see what's going on around you. You don't have EBITDA per ton of cement going up the way it is. You cannot have construction and real estate activity go in sync. DLF is hitting new highs. There is a, whether it's fair or not, 100 crore rupee house sold in Camellias for 10,000 square feet. Maybe that was one off. But the language, the body language, the essence of the spending is huge. Now, I also agree. Even I have always tried to book profit in mid caps, but it's been a no-show. So your actual mutual fund performances are lagging because there was underperformance or under ownership of PSUs. I mean, REC, PFC are hitting new highs. And we are missing the bigger picture that the bond market inclusion, some of the other, positives are all going to see huge inflows into sovereign debt and so on. I'll not imply much, but I think, Nikunj, that this sell-off in Reliance, HDFC Bank also may be coming to a head. So you'll see these levels be a very good ground for holding. Secondly, IT mid-cap has actually outperformed large cap. And I still think LTIM, Persistent, Coforge have miles to go. So as a basket of stock, I think mid caps are still going to rule the roost. And you are closer to year end, where again the Diwali effect, the left out feeling is going to be humongous. So this is the next 2-3 years belong to mid caps, and we'll take it from here till the election and budget that they can still outperform.
You give a new mid cap, large cap, and a small cap idea. I'm using the word new. Every Friday, you give a new small cap, mid cap, and a large cap new idea. And I have the list, so I know the whole ideas. This time it has to be new one, Basin sir.
So let me see. Yesterday, IGL fell 5%. And one room on talk that EV's policy from Delhi government. Firstly, Delhi government itself doesn't know which side of the state they are because they are also headed for state elections. Secondly, EV policy is a no-brainer by 2030. But believe me, 8% of IGL's revenues come from DTC, 10% from Ola Uber. It had a EBITDA of 1900 crore last year and a net profit of 1650 crore. 10 or 12% volumes will get affected. That also in 2030. At a stock which trades at just 18-20 times 1 year forward, I think IGL is a must-have. From here till Diwali, 575, 600 can easily come. Results are on the first. As a bias, I think that can be very strong. So IGL would be my mid-cap pay. And in large caps, for today and for the next week and for the next month, it is going to be Reliance. Look, Reliance results are slated for next week. Nikunj, you are seeing the way retail, ARPUs and the geo business is performing. I think that oil to chemical, their biggest conduit is going to be doubling of Russian crude, which is at a discount, and the refining margins, which have bottomed out on GRM. I think Reliance numbers and the guidance is going to be very positive. Plus, the added cake could be that in this result, you could also hear something of the demerger, not on the geo-financial, but on the other business, that is the retail part, which could be a real unlocking of this stock. So from here till year end, 20% upside in Reliance.
Okay. Let me now bring on board Amur Lakshmi Narayan, Managing Director and CEO of Tata Communication. Lakshmi, good morning. Thank you for joining us. It's been a while we've not interacted with you. So Lakshmi, bulk of your growth seems to be coming from inorganic switch acquisition. Break down the quarter for us. How much of the growth for Q2 was organic and how much was inorganic?
Yeah, organic growth, overall year on year, if I look at Q2, we have grown 10%. And in our business, I would put more emphasis on how we are doing year on year rather than a quarter on quarter. So quarter on quarter, the data growth is 0.7%. But I think the overall on the overall aspect, we have grown 10%, which is very, very commendable, I would say. Also, given that the macro conditions at the moment are not that favorable, so the decisions are getting delayed. So last quarter, I said that some of the deal closing has got pushed out, and that's playing out. But despite all of that, we are still showing a 10% year-on-year growth. I think is still a good performance.
Morning. So the 10% year-on-year organic growth has been clocked in Q2, but in the second half, do you think that this growth will accelerate or will it slow down?
Our aspirations to grow was much faster. Having said that, the macro conditions are what they are. So we are going to put our head down, make sure that we continue to do all the right things. We invested in our products and we continue to invest in our products. We have acquired Switch, where I said the integration, the teams are doing an excellent job. And Kalera, we have had an accelerated closure and we will be integrating that. So, we will put our heads down, make sure now the execution is sharp. And whenever the market is ready, we will be prepared, is what I can say. So I don't want to read out and look out for the H2, how it would be. But overall, we think we would still do a double-digit growth. And with the inorganic coming in, our growth would be faster than that.
So Lakshmi, on the margins, we've seen it slide from 26, I beg your pardon, to sub 21%. Now that you have prepared us for this drop on account of acquisition impact, when do you see the recovery in margins? Because that's a critical point which markets would mull over.
If we have to grow, if you look at our trajectory in the first 3 years, we got our basics right. From a 16%, we got our EBITDA up to the levels we want. We got our balance sheet strengthened. And we said that we have to invest and we want to invest so that we can grow. And in order to grow, we have to make those investments. And that is what exactly that we have done. And as a result of those investments, the people additions that we did in both in the front end of the market and sales, as well as in the products and solutions and delivery and everything, the cost was expected to go up, and it's in line with what we wanted to do. So this is not a surprise. And I explained even last quarter when the margins came down. That is one major factor for that coming down. The second factor, as I had explained previously as well, is the mix of business. We were less than 30% of digital portfolio, and we called out that we want to make that to 50% going forward. And this quarter, we will be 36%. But as the digital portfolio grows, the digital portfolio has lesser net revenue margin, and a lot of our digital portfolio were not EBITDA positive, and therefore it has that impact. But we do have a glide path for all the products to improve from here on. But we have to make those investments. Otherwise, we'll be caught in a catch-22 situation, which we were some time ago, that because of lack of investments, we can't grow. And either the choice is that we produce good margins and show a mediocre growth, or we want to invest into new products and have an aspiration for faster growth.
Sure, but the question is that whether or not this phase of investment is going to continue for some more quarters, and I want to understand from you whether or not it's going to turn worse before it gets better.
We said that we would, post-integration, Kalera, from a negative EBITDA, we would get to an EBITDA neutral in about a year's time. and we would make it EBITDA positive and get it closer to a double digit in the medium term. And as we do that, naturally our overall margins will also go up. But in the short term, yes, there will be that effect of the dilution. So, I just want to explain another factor. When you look at the overall margin that you see, and if you unpeel the layer of what is Tata Comm's, what I would say the core. So leaving out the switch, for example, the margin dilution from last quarter is only 40 basis points, which is largely because of the mix change as we grow the digital business, as well as the M&A related expenses of Kalera. Right? So that is in the range of what we want to do. But then if I stack up the switch, which has diluted the margin a bit, as well as the dilution that we have in our subsidiaries, which has been a drag from a margin perspective, and those are the ones that have pulled us down. But the core Tata Comm business are still in that range, and the dilution hasn't been as much, and it's as per the plan. Whatever dilution is happening is because of the mix change that we explained earlier.
If you want to prepare us for how much margin pressure we should brace ourselves for, markets, they don't like surprises. So if you have to, let's say, give a sense or indication, how would you summarize it?
I don't want to spell out exactly that, but the math of that would be available because the numbers of Kalera were public. But we are working very hard in other areas to see how we can better that. But yeah, I think there would be some pressure in the short term as we integrate all of this. But the only assurance I can give is the core business will continue to be healthy. And these investments, as they play out, they will have that effect of going down, but we will bring it back. And that's where the value creation will happen, right? So in terms of as we bring these businesses back to EBITDA neutral and eventually to a reasonable EBITDA margin, which we call out in the case of Kalera to be a double digit. And similarly in the switch, when we move that to a double digit, we would have a strong case and a strong base once again, right? Because we moved this company from a 16% to what it is today. But we have to make those investments, and those investments are made for long-term value creation.
All right, good to have you on board. Thank you so much for giving us that clarity. Let's get in a take from you then, Sanjeev, what the outlook is when it comes to some of these consumer durable companies. We were talking about Havells, Voltas, and how they really haven't managed to cash in on the massive consumption boom, the festive sales, the overall pickup. Why is that, you think?
Yeah, some of parts I thought Havells numbers were very reasonable. Now remember, Voltas also has some exposure towards the Middle East, and there could be an accounting over there. But Avan, give them more time. We know that the coming few quarters will see a large part of the consumer electricals because of house building, new house flow, and so on. And these two brands have taken larger market share than anybody in consumer electricals. So I would still put my money on Havells. It's an expensive stock, and in the consumer electricals, it is now trading like an FMCG. But the type of basket, the type of models that they are moving from LED to solar panel to your crab tree, all the brands are doing extremely well. I have not had a conference on this conference calls on the numbers, but yesterday we had a buy around that 1330, 1340. We think that this could again rescale those new highs closer to 1550 by the end of the year. Voltas is something which the Tatas are actually very, very bullish on, and they are putting their money into more on their marketing and their consumer facing arm. So that and TTML, just as you spoke about Tata Community, those are two Tata consumer-facing arms, which I think in the near term can do relatively very, very well because of the management's focus on them.
Sanjeev, for joining in. Good to have you on board as always, picking your brains and getting all those stock ideas. Well, it's time to connect with Sandeep Sabharwal now, who joins in on the show. Hi, Sandeep. No smiles. It's Friday, end of the week. What weekend plans? Are you going to be glued to your TV screen with cricket?
On Sunday for sure,
Yes.
but not.
You know, Sandeep is never in favor of watching cricket matches because he's an investor in PVR. And investor in PVR, they always lose out when cricket matches happen, right, Sandeep?
No, no. See, your you or what you do should not be a factor. Should not be affected by the position you hold. So I don't think that's very valid.
But you've got PVR Inox, which will show the screening of some of the matches as well of the World Cup. So maybe Sandeep can head over there.
The 699 scheme is brilliant. Just think about it. 699 rupees.
Yeah.
You can watch 10 movies.
Yeah.
You can go anytime between Monday and Thursday. I think it's a great scheme. I mean, just, while the ticket price is attractive, there's no discount on popcorn and Pepsi. And that's where the high fat margins are. So I think it's a very, very innovative scheme where they're ready to let go of some ticketing revenue, but they may actually be making the footfalls very attractive. Is that the logic, Sandeep?
Yeah, so I think that's obviously the logic. And secondly, on the weekdays, their average occupancy, even in very good movie weeks, tends to be more near 15 to 20% at most, like more near 15-16%. So in any case, the seats are there. Now, if some seats get filled by this kind of promotion, and like you rightly said, the F&B revenues remain the same. Because if you see this quarter results also, ticketing revenues were around 1,300 crores. F&B revenues around 650 crores. So they're nearly half of ticketing revenues, which is very significant and a high margin business. So I think they're trying to drive all ends of the revenue stream. Even the advertisement revenues, which were lagging behind, have picked up. And ad revenues go directly to the bottom line. And ad revenues are a factor of how you did in the previous quarter. So advertisers see what was the viewership in the previous quarter and then decide the next quarter allocation. So I think that revenue will also keep on improving.
You like Voltas, and I know they will turn around, but I don't know when. I think it's now getting slightly painful to understand that why they are still struggling. The margins weren't great, Sandeep, and at a time when the engineering business is doing well for other companies, Voltas is just not getting their mojo back.
Actually, results are not bad. It's just that the reported numbers look bad because the revenues were much above most analysts' expectations. And unfortunately, some of the projects they did years back in the Middle East, they still have to have some write-offs for that. So they wrote off 85 crores because of that. And if operating profits 85 crores were added, the results are actually much above most analysts' expectations. Now the key is for us to find out from the management, like, is this the end of the write-off cycle, or there's something more beyond this, because it keeps on recurring periodically. But overall, I think on the consumer engineering side, they are doing well. Electromagnetic, mechanical, given the fact that their order book now is around 8,700 crores vis-a-vis 5,500 crores same quarter last year. And a majority of the projects are now domestic. So I think that write-off, uncertainty, etc., will not be there. So I think such companies we have to buy in bad times, then they end up giving you 30-40% kind of returns. So I think if it gets sold off because of what they have reported, I would still be a buyer.
I'm harping a little too much on the media space, but it's just interesting because there's a latest report that's come out on DB Corp as well, talking about how their digital app is pretty strong. There's limited competition as well, and there's a recovery in print ad revenue that is fairly evident. Just going by the kind of performance as well, Sandeep, just wondering whether or not you have any take on a DB Corp?
Yeah, so I don't hold the stock and don't track it very closely, but I was very surprised with the last quarter results, which were actually very strong. So at that time, I was wondering that whether this stock should perform or people will still think that print is going out of vogue, but the stock did reasonably well. So I think there's a pickup in advertisement across the board, and it's reflective of the overall economy actually doing reasonably well now, once given the fact that inflation is under control, which most of the FMCG companies have also indicated.
Yes. In fact, Sandeep, just wanted to understand what you made of ITC and Unilever as well. I mean, ITC pretty categorically now saying that, they actually see green shoots when it comes to rural recovery?
The recovery in the consumer demand will always happen after a period of like when there's high inflation, people cut back, then inflation comes under control, and then as inflation remains under control and prices don't move up, that's when consumer demand picks up. So I think there will be a pickup in consumer demand for sure, urban as well as rural, because inflationary trends so people just look at crude oil and think that inflation goes up and because of that, but there are various other dynamics. You look at all other metal prices x of uh, crude prices, they are down for this year or hardly up. Most, if you look at palm oil, which used to be very correlated to crude oil prices, their prices actually at 3 to 4 month lows. So I think various factors of inflation are down, and that will lead to a pickup in consumer demand. And most of these companies should do better going forward.
Of course, ITC has, delivered all guns blazing. The key positives, of course, being the fact that the cigarette volumes are much higher than what the street was penciling in at about 6%. The estimated number was anywhere between about 5 to 6%, and the revenues as well have come in higher by 10%, wherein the EBIT has jumped up about 8%. Even the FMCG business has delivered pretty well on a high base. About an 8.3% growth is what they've seen. EBIT come in off an uptick of about nearly 37%, and the margins as well come at about 8.3%, so that's looking good. The hotels revenue as well has done well. G20, higher travel trends, all of that really contributing to the hotels business as well. There too, the EBIT has seen a jump up of 50% no less, and the revenue has seen an uptick of about 21%. But Kunal, on the charts, can ITC push further after these numbers?
Well, it seems like, because in the last couple of days the stock was actually finding some bit of momentum from 440. The stock had come back towards 455, 460 levels, even though it slipped back again towards that 450 mark. But I think with the momentum coming back for ITC, the stock rising back above the 50-day moving average on the daily charts, I think is sort of an indication that maybe the worst could be behind to the stock price. But on the other hand, we don't at least I don't expect the stock to get into a very strong kind of a rally, in the sense like what it saw maybe one and a half year back, when the stock was at 200, 220 levels, and then it moved up to almost 500 mark for ITC. So I would expect a more of a gradual recovery. What the stock ideally does is, builds in a base, spends some time at the support levels, and then gradually moves up higher. So I think in that reference point, I would look at 440, 430 approximately as a fresh base for ITC, and traders can hold on to long positions or maybe create fresh longs, keeping that as a stop loss, and look out for maybe a 10% target in the next couple of months.
Just pull up the 1 week charts of some of these stocks as well, because it's been an interesting move for some of these. And of course, do remember, we will be getting you that interaction with the top brass of IndusInd Bank later on down the line on the show today. Okay, the Zomato block as well in pre-market, 1.09% equity has traded in the block deal. Do remember, this is the news reports as well that were going about that SoftBank is looking to liquidate some of their stake via the block deal, where they currently hold about 2% stake in the company. So keep an eye out on that. But yeah, I was talking about some of the interesting movers, and pull up the 1 week chart of a FACT. FACT, nearly a 36% move is what you've witnessed in the week gone by. So that's been a smart mover. There's been an ITI as well that has seen a smart near 30% gain. GSFC, RCF, so a lot of these fertilizer stocks have really had a pretty strong run. Naresh, do you track anything looking good?
So in the fertilizer pack, one has to be much more careful out here, because there are no follow-up moves in the larger names. So we are not seeing a Coromandel do well, not seeing any follow-up actions. Chambal is not doing so. But yes, RCF is trying to make a breakout, but we've seen a lot of PSU names do well in the fertilizer pack, but some of them could correct also going forward. So I'd be a little careful on this sector as such. Don't have a clear view.
Careful of the space, no clear view. Meantime, what's your take then, Sandeep, when it comes to the entire auto space? After having assessed the kind of auto sales numbers that have kicked in, do you think that it would merit banking on a healthy festive season and strong demand up move as well in the next coming months within the space?
Yeah, I think among the spaces in the market which should continue to do well, I believe auto is one where they are coming off a period of subdued growth, so volume growth is likely to pick up. The input costs are well under control, and in fact, I think only among the larger companies, only Bajaj Auto has come out, and they indicated that they don't see any cost pressures per se. So a pickup in demand combined with a potential operating leverage possibility and improvement in margin should help these companies actually report earnings better than what most analysts are expecting. So I would think that auto is a good space. So among in two-wheelers, Bajaj Auto will be the preferred pick, although it's moved up. So I think we have to look at when people should buy. But M&M, Maruti, I think they are pretty well placed.
M&M, Maruti, those seem to be some of the calls coming in from Sandeep within autos. But Kunal, if you had to stack up a performer from within two-wheelers, which has already been, that's TVS Motors, or for that matter, Eicher, which has been the go-to before, of course, competition from the stable of Hero MotoCorp and Bajaj Auto came, and especially Bajaj Auto, what it's done year to date. I think almost a 30-odd% uptick, and then yesterday that big breakout. What do you do within the two-wheeler pack now?
So, I did a comparison from COVID lows because that was the first bottom which was formed for many of these two-wheeler names. And apparently, I think TVS Motors had done exceptionally well. It was the highest gainer. Bajaj Auto followed suit. Eicher Motors, Hero MotoCorp, they've been somewhere in the tune of, I think, 200 to 50% to 60% approximately from the COVID lows. But I think TVS Motors has been a standout because that stock has outperformed these stocks by a margin of, I think, 400, 500%. I'm talking of it from the COVID low specifically.
So that would be like 2020, a
2020
couple of
lows.
years.
Yeah. So that's a perfect benchmark because that was the starting point of the rally for the entire markets. Now what has happened is in the last 2 or 3 months, Bajaj Auto is picking up pace with the likes of Hero MotoCorp, Eicher Motors. These stocks have been a lot more sideways. So which means that in terms of a fresh breakout, if I have to take a trade, I would look out for Bajaj Auto from the two-wheeler pack as a more stronger candidate of a breakout. Maybe Eicher Motors could continue to remain into a range. The stock has every time shown false starts for itself, but it's not converted into major uptrend or a breakout. So which means that the stock may consolidate for some more time. I think Bajaj Auto emerges to be a leader in that category, followed by Hero MotoCorp, and then probably we can place Eicher Motors as number 3.
Okay, that's interesting data that you're tracking within the entire auto space as to who has emerged a leader from those COVID lows. I wanted to understand from you then, Sandeep, how you've read into the kind of earnings come in from the FMCG majors and, just going by that, what it would be your outlook down the line in terms of the earnings season overall? Any hits, any misses that have struck you in particular?
The FMCG company results have been in line with expectations. So I think yesterday was the big day for that ITC, HUL and Nestle. Nestle obviously did much better in terms of profitability than the other two companies. But the outlook from here on is relatively much better off. Now the question comes about valuation. So valuations of these stocks are never cheap. So one needs to allocate to them whenever there is some sort of correction because of some reasons, etc. But overall, the picture is looking decent. Clear buys which can give a very strong return don't seem to be too visible. Britannia has corrected around 15-17% from the top. So that could be interesting. So that's something I'll watch out as the results come out.
Looking out for Britannia and awaiting those numbers. Sandeep, good to have you on the show as always. Thanks for taking the time out. Zomato, while that 1.9% equity has already changed hands and that was an anticipated block deal, Zomato is also going to be in focus today, especially after Blinkit's numbers, and the losses are up over 8% and they're going to almost hit over 1,000 crore rupee mark. So that's another stock which is going to be in focus this morning. But let me welcome on board Nissan Joseph, the CEO at Metro Brands, and talk about how their quarterly performance has been. Mr. Joseph, good to have you on the show. In the second quarter, your revenue growth momentum has clearly been strong despite the shift in the festive season, which gets pushed back to Q3. Tell me what the demand trends have been so far.
Well, I think, good morning and thanks for having me. We're pretty convinced that there is no long-term demand headwind, or economic headwind. What we really see is a timing headwind, with the festivals getting pushed out later, wedding season coming a little bit later, and of course, the pent-up demand that we went against last year. So I think a 15% growth that we posted is a good indicator that the economic pillars of what supports our growth are in place.
Having said that, when it comes to demand overall, the one trend that we're picking up, and this is, sector agnostic pretty much across the board, is premiumization. It's the urban elite which are spending and spending a lot. Tell me what's your experience been when it comes to, purchasing power and trends that you're seeing within the tier 2 and 3 cities?
Yeah, even in tier 2 and tier 3 cities, we're quite impressed and glad to see that the premiumization wave continues. Last quarter, our sales over 3,000 rupees was 48%. So 48% of the goods we sold were over 3,000 rupees, which was 44% the previous quarter. So that's a good indication that the premiumization strategy that we have in place is working, but also that the consumer favors premiumization. And I think it's not so much about premiumization as much as we've come to now as an economy where we see value to products, we see the advantage of investing in products, and we're seeing that across the board, whether it's in automobiles or in watches or what have you.
Okay, fair enough. Let's also get in a sense, Mr. Joseph, hi, morning, firstly, as to what the outlook is when it comes to your margins, because they do continue to remain under pressure. So what exactly has eaten into your margins? Do you think that a 30% EBITDA margin for FY24 is achievable, or it doesn't really seem like it's on the cards?
Well, good morning, Avan. I think our margins are very much in line with what we expected, right? So if you look at our gross margin business, it has continued to perform very similar Q on Q, not previous quarter to this quarter, but if I compare quarter of last year, because Q2 typically has the end of season sale for us, right? And that's what we went through, but equally, we're quite pleased coming out of it. Our EBITDA also hit the equivalent EBITDA to what we hit last year in the same quarter, which is 30%. Ivan, we've always guided to EBITDAs north of 30%, and from where we sit at today, and as we see the momentum come back for the festival season, we're quite convinced and very solid that we would be able to deliver more than a 30% EBITDA for FY24.
Okay, fair enough. And given that you've been consistently gaining market share, what is the outlook on your market share going down the line? Are you worried at all about the increasing competition?
Well, I think competition always worries any business, but I think it's good in terms of where we are as an industry. Our per capita consumption in India for footwear is one of the lowest in the world. What competition does is increase awareness, increase accessibility, and gets people thinking about buying more footwear per capita. So at that level, it grows the market significantly to have more players provide good shoes to the public. On the other hand, competition is competition, right? I think what comes back to it is we've got to stay focused on what we do well. And what we do well is we operate our stores effectively and with great rigor, and we have a lot of financial discipline in how we go about running our business. And I think if you stay true and keep your customer first as a retailer and do everything customer backwards, Aman, you typically are able to sustain and take advantage of competition coming in and helping you grow the market as well.
Good to have you on the show. My colleague Vinny will be with you in just a bit. She has some more follow-ups to that. But let's just move on and let's talk about what the market construct is looking like, because today it seems like it's going to be a bit of a shake-off given the global handover and given what the GIFT Nifty is indicating. So let's see where we actually move on for that, because today a conclusive breach of that 19,600 mark is definitely on the cards, and let's see whether we are able to defend the 19,500 print, because we tested that yesterday too. But let's get in some mid-cap strategies, considering that's where all the strength is. Naresh, what's on your list?
So continue to like Motilal Oswal. The stock has done really well in terms of the last few days. But if you look at the whole sector also, we are seeing a trend across the whole sector, whether it is broking and AMC. Motilal Oswal gave a breakout of 950 and is holding on for the last 4-5 sessions. The stock used to be 950,000 back in 2021. Even back in 2018, this used to be a resistance. So now it seems like a multi-year breakout in the making. I would have a target price of 1200, stop loss to be kept at 950.
All right, let's get in the mid-cap strategy from Kunal. Kunal, what's on your radar?
So AB Capital is something which I'll be bullish on. The stock has formed a base at the 175, 78 mark. In the last 4 or 5 days, the stock has shown a lot of volatility, but then yesterday the stock managed to break out that 180 barrier. So would suggest a buy, targets of 200, stop loss at 177.
Okay, let's also get you some buzz across dealing rooms. And Sharad is here with all the cover this Friday morning. Sharad, what's the stock that you're picking up?
Well, yes, in focus we're having IIFL Finance, and the buzz in the street is a strong DI participation and interest is being seen for the stock. Now, important thing is the company came out with a very strong set of Q2 results as well, and the brokerages such as HSBC, they have stated that the growth was led by a strong demand coming from the gold loan segment. Also, we did check the numbers of DIs, how they have actually increased their stake in the company, and the number has increased from almost 2% to 4.7% on a sequential basis for the September quarter as well. And if you also look at the month of September itself, important developments coming in where two important mutual fund houses, the DSP Mutual Fund as well as HSBC Mutual Fund, added fresh positions as well as new positions to their existing holdings in the month of September as well. Now, DSP Mutual Fund is having roughly 3.5% stake in the company and is expected to go up as well. So, a strong DI participation is being seen for IIFL Finance.
Okay, let's move on and let's discuss all the stocks that are going to be in focus this morning. A lot of earnings coming in, especially from the mid-cap side of the market. So let's listen in to the editor's take.
United Spirits, United Breweries, 3 years ago, what the market positioning is and versus where they stand right now, whether it is inflationary pressure or competitive environment. I mean, they are companies which have some of the biggest brands, both, I mean, they both are owned by different, global groups now. But both the companies, in a sense, if you frankly ask me, they've not really lived up to the kind of reputation they currently have. Now, whether it is the volatility in the barley prices or volatility in molasses prices or perhaps both, they've had margin problems. Volumes have not been extraordinarily strong. I mean, for United Breweries per se, you've got the entire landscape also really seems to be changing. Even though they have the most dominant brand, Kingfisher, I guess somewhere the superiority of Kingfisher also seems to be getting challenged now. So frankly, from a market standpoint, this has just been one of those stocks which could be called as a hope investment. That hope has not translated into reality. Because when you have a choice to choose, you would say that, do I choose an ITC which is giving me better margins, more consistency, and more promise of a dividend and hopefully a buyback soon? Or do I choose United Breweries, which is a pure play on Indian youth consuming more alcohol, and a company which has great brands? So the latter in this case has really not worked so far. So that's really been the sticky story, if you frankly ask me, for UBL. The management has changed. A lot was anticipated when the management changed. But frankly, in terms of not last quarter, but last couple of quarters, they've not really done something extraordinary.
All right, and let's find out now, moving on, what the top index calls are from our chartists. What are they advising by way of positions? Well, it seems to be a steer clear, a sell and an avoid from Kunal as well as Santosh. But Naresh sticking his neck out. He believes that even at the current levels, it's a buying opportunity, despite the fact that he alluded to the fact that it could be a sideways movement. Ditto for the Nifty Bank. Buy, says Naresh, avoid according to Kunal, and sell. That's the take coming in from Santosh Meena. Okay, meantime, let's also check in on some of the interesting losers that have really played out in the week gone by. You've got a Hudco, Kunal. That stock has dipped about 12%. Of course, it's been key as a newsmaker. And Delta Corp is the other one with a 9% meltdown this week at 127 thereabouts. What's your take?
So I think Delta Corp would continue to remain under pressure. I don't see any immediate relief into the stock price. There could be technical rallies for the stock price because the indicators, they would time and again get into an oversold territory. But the way the stock is seeing news flow, the selling pressure for the stock price, I would be of the belief that the stock may fall a lot more from current levels as well. So I think I would probably take every rallies for traders who've been holding on to long positions to try and exit longs for Delta Corp, unless the stock breaks past about 160 mark, which could be a first level of confirmation that maybe the worst could be behind the stock price. Hudco, on the other hand, the stock almost a week back when it was at 90-95 levels was at a 50% to 70% divergence from its 200-day moving average. So at those 95 levels, the 200 DMA for the stock was around 57-58 levels, and those are the kind of divergences which don't sustain for too long. So I believe that what you're seeing right now is a mean reversion process for many of the PSU names, Hudco, YTI, etc., which I believe could probably result into another at least a 10-15% correction. So one should not be in a hurry, wait out for a correction to play out in the levels on the downside. I think that could be a good zone to buy these stocks.
Okay, that's the take coming in on some of the underperformers. Let's just revisit what the pre-open rate for the Nifty has settled in at, because I think today is going to really be more about what the global setup is like and how we actually absorb the heat coming in from the spike in the US yield, which has been all the way to that 5% mark, the first time since 2007, and B, of course, what happens with our own internals and the earnings reactions which come by. Having said that, the show of resilience and the kind of DIR participation that we've seen in the market of late, that continues. But yeah, I mean, to say the least, this week, of course, has been shaky. Next week, in any case, you're going to have a truncated week with Tuesday being a market holiday. So let's see which way we actually head from here. In the last 6 sessions, 5 out of the 6 sessions have been on the downtake for the Nifty. Having said that, we're relatively more resilient as opposed to some of our global peers. Banks, they seem like the weakest link, and I'm not talking about the overall banking pack, but some of the large heavyweights are the ones which haven't quite been participating, and that pretty much seems to be the case of late. It's a very specific earnings reaction kind of day that we had yesterday. So let's see whether a similar picture actually plays out today also or not. The first rates then on your screen so far, defending the 19,500 print, but yes, a 0.5% dip. That's pretty much par for the course. The market breadth as well is a little bit challenged this morning, although you are seeing a relative outperformance as opposed to what's happening within the large caps from the broader end of the market. The Nifty Bank also starts off a little bit softish in trade, but first let's start by talking about what's happening within the FMCG pack, because those are the big giants which came out with their numbers post-market hours. That's Unilever in trade for you. The numbers were largely above estimates to a little bit in line. The margins have actually risen by about 690 basis points. But no, you're not seeing much excitement on Unilever. 2508 is where that stock is. What about ITC? That was definitely a better performance. Healthy Q2 internals, cigarette volumes were a beat at about 6%. FMCG revenues as well showed good growth. And of course, the hotel segment, because of its low base on a year-on-year basis, that was also quite a bit of jump up. But no, not much excitement either on ITC. 448, so pretty lukewarm response to its numbers. Jindal Stainless, the Q2 numbers have been in line. Signed, their EBIT margins have come in flattish on a sequential basis, but the EBIT has risen about almost 5%. Metro Brands, we were just chatting with the management. EBITDA has jumped up about 5.6%, revenue uptick of about 17%. Very marginal move coming in there from Metro Brands as well. And then, of course, I want to check in on what Havells is up to also, because the Q2 numbers look a little bit below estimates to in line. Havells, though, starts off flattish in trade. Emphasis also came out with its numbers. The constant currency revenue has been flat. Deal wins at about $255 million odd, 1% higher for Emphasis as we speak. And then UBL also came out with their numbers. The numbers, of course, are a little bit below estimates, but UBL has gapped up 3.25% there. Voltas, let's check in on that also, because there has been quite a bit of margin pressure. EBITDA has come in down by about 30%. Voltas down about 1.25% as we speak. And Tata Communications also came out with their numbers. Again, the numbers haven't matched up to what the street was expecting. 2% lower for Tata Com as we speak right now. What's Zomato up to? You just had that block deal take place. And then, of course, the Blinkit performance as well. Zomato has covered its losses. 112 is where that stock is. Also want to check in for a follow-through on a Hero MotoCorp, on a Bajaj Auto and an LTIM. And after that big breakout on most of these names, you're not quite seeing a follow-through come by, at least not on Hero MotoCorp. Bajaj Auto starts off flat. And LTIM sees some more uptick of about almost 0.5%. Actually, it's not all that bad. We're skirting around that 19,550 mark, Kunal, and a fairly resilient broader market.
Absolutely. I think, so the indices are doing one thing altogether, but the broader market, the opportunity to trade is also pretty much high. The stocks are seeing a follow through even after a breakout or positive close, maybe yesterday or day before. So I think that's a very good sign that the market breadth is still very, positive as such. So I would probably be looking out for more mid-cap names and smaller cap stocks. Paytm is something which looks attractive as an opening trade. The stock is trading at 955, 960 odd mark. It's confirmed a swing breakout on the short-term charts. Would be something which I'll keep an eye on, especially on the opening trade.
All right, that's the view coming in on Paytm. Meantime, taking a look at the overall market move this morning, Naresh, what are your key takeaways with the fact that we are around the 19,550 mark, and what would be the first trade that you punch in?
So the key takeaway is we continue to see broader outperformance. The Nifty small cap 100 is just 70 points away from a new all-time high. It did hit it 2 days back, so we are not seeing much of a correction in the broader markets. So time to remain stock specific till the time we don't break 19,300. On the stock side, ACC looks like a good risk reward trade here at 2020, 2030.
Okay, Kunal, Naresh, we'll see you again later on in this show.